What's going on, guys? Welcome back to another video here. We are just about to get into probably the most important day of the year. The Fed is going to cut interest rates tomorrow. Now, from everything that we've talked about in these videos over the last couple of weeks, specifically one last week where I told you guys there is going to be a person that we need to watch for their statements to get an indication of what the Fed is going to be doing. That person has made a very important statement today that we're going to be going over, the Fed whisperer, Nikki Leaks. So we're going to be covering that as well as all of the prior times that the Fed in recent history has cut rates, what has happened to the market, has a recession happened after these rate cuts have occurred, and everything else that you guys need to know and understand going into tomorrow with the FOMC meeting. Now, again, we are going to be live streaming this tomorrow as well, so make sure you guys are aware of that. But I also want to take a moment here to just give a brief shout out to all the members of the Discord community that I recently launched. Honestly, guys, seeing all of your performance and the amount of success that you guys have had, whether you are an experienced trader, a new trader, can spend a lot of time on the charts or not, it's been absolutely awesome. I'm throwing some of the screenshots of the gains up on here. If you guys want to come in there, get the watch list of stocks that are about to explode before they do every single week, the pre-market plans, all of the educational courses, the private live streams, the macro research reports, the single stock research reports, access to the community, and honestly, the best trading community out there right now. I'm offering a 2-week free trial to everybody, but again, that is going to end soon, and it's going to be waitlist only at the end of the month. So if you are interested in hopping in, make sure you check out that link down below. The first thing that I want to cover with you guys here, though, is some of these prior times in history when the Federal Reserve has actually changed their policy stance and gone from a rising interest rate environment to a declining interest rate environment. So when we move over here, taking a look at this screenshot in September of 1984, the size of the first cut, 50 basis point. Was there a recession in the next 12 months? No. And the returns after the first cut over the next 3, 6, and 12 months, in this case, we had 1%, 9%, and 14%. When you look through this data here, there have only been 2 instances in which we have seen significant declines in the market. All the last times that we have gone from a rising interest rate environment to a declining interest rate environment, and both of those scenarios had deep underlying issues happening with not only the market, but with the broad economy as well. Obviously, we all know about 2007, 01, and 2000 was really the dot-com bubble burst. Again, 98, I believe, was long-term capital management. I'd have to really refresh that there. It was either 95 or 98 there for the blow-up of LTCM. But as you guys can see here, historically, the performance of the market has been relatively good in the following 12 months after that first cut. When we look at the returns here, we have 14%, 14, 17, 22, 23, the 2 declines, and then 12% on that first cut in 2019. Now, when you think about the market right now and where we are, well, we're basically at all-time highs. We cracked the all-time highs today in the broad market, but again, a lot of people have expected that the market would not be here when the Fed is about to cut rates. But what I think we have to understand is that due to what happened in 2020 and 2021 with all of the excess capital injected into the economy, and you see all of that money flow up towards asset holders, well, think about it from their perspective. They have to allocate capital. They're not going to keep it in cash, especially with the continuous debasement of currency. They have to put that money to work, so it does help buoy asset prices a little bit. Now, I want to get to the really, really important core parts of this video here that I know a lot of you guys clicked on this video for, and it's the rate cut leaked. What are we going to see tomorrow? Now, again, in my personal opinion, I think the Fed should start out with 25 basis points, but as we're going to see here and as we're going to go through, it doesn't look like that's going to be the case. Now, remember, the person that we were talking about to pay attention to last week was going to be Nick Timiraos. I like to call him Nikki Leaks. Some people call him the Fed whisperer, but this is a very, very important statement. The Fed faces a finely balanced set of considerations over whether to cut by 25 or 50 basis point at its meeting that begins today. Remember, the closed door meetings today. The interest rate decision comes out tomorrow at 2 p.m. And then we also get the Q&A from Powell at 2:30 p.m. Eastern. The case for 50 comes down to what Fed officials call risk management, but what might be thought of as regret minimization. Per former Dallas Fed President Robert Kaplan, if you cut 50 here and you think the Fed will need to cut again after that, you are unlikely to regret such a cut even if the economy chugs along between now and your next meeting. Now, that's incredibly important because what did we just see today about growth expectations for the third quarter? Well, when we come over here and look at the GDP now from the Atlanta Fed, the latest estimate right now for Q3 GDP is 3%. The GDP Now model estimate for real GDP growth at the seasonally adjusted annual rate in the third quarter of 2024 is 3% on September 17th, up from 2.5% on September 9th. So they expect growth to be higher than previously expected. Now, typically, when you would be looking at a market and you would say, well, what would be the normal factors that would cause a Federal Reserve or a central bank to start moving down in terms of their interest rates? Well, it's typically a recession. Not in this case. We have a lot of different factors going on. Unemployment's moving up. We do see inflation moving back down towards the kind of levels that the Fed really wants it to see. We are moving down, especially on PCE, the Fed's preferred metric of inflation, towards that long run 2% target. But let's come back over here and continue reading this. The case, but if you cut 25 and things worsen a lot in the coming weeks, you'll feel bigger regret as you'll be behind the curve. That is an argument that many have made about what the Federal Reserve has done over the last quarter here. A lot of people were expecting and hoping for a 25 basis point cut in July. We did not get that. And remember, we do not have an October FOMC meeting. So we have September, the September meeting. We don't have an October one. And then we have November and December. So the case for 25 boils down to some combination of one, process issues, i.e. 50 will signal something more urgent. There's an election soon. Communications were not explicit enough about the 50 in this run-up to the meeting. Now, just a side note here, when Powell and the Federal Reserve says that they're not political, and then you see a former Fed president coming out and saying that there's an election soon, I mean, we all know that's nonsense, but that's just further confirmation. Now, the most important part about this, in my opinion, is that 50 will signal something more urgent. If you guys remember what happened over the weekend, all of a sudden, we saw that the prevailing expectation out of the market jumped from 25 basis points to 50 basis points. And I can show you guys that right here. Last week at this time, the market in general was pricing in a 34% probability of a 34% probability of a 50 basis point cut. And that was after the CPI report, which we were looking towards to give us that last piece of the puzzle to understand what the Fed could potentially do. Now those expectations are up at 67%. What's interesting about this is that the debate that we've seen in the financial media, and it's a debate that everybody is having right now, all market participants, is a 50 basis point rate cut going to spook the market and basically be a signal from the Fed that things are not as they seem and the actual economic conditions in the United States are worse than everybody is thinking right now. And maybe some people start to think, well, maybe the Fed knows something that we don't. But if the market is pricing in right now and they're expecting a 67% chance of a 50 basis point rate cut, and the market is at all-time highs, that doesn't scare the market. So when you combine a lot of these statements together that we're seeing, it does make sense that a lot of these Fed officials are leaning towards that 50 basis point cut. Now, here, let's continue. The next part here, a view that the economy is doing just fine and will continue to do so with more gradual reductions. Now, that's kind of the point that I'm making, where you could easily see unemployment maintain at some of these levels here. You really have to watch out for inflation expectations, which I probably will create another Twitter thread about for you guys, and maybe a YouTube video as well, because that, in my opinion, is going to be the most important data point going forward, just because of the self-fulfilling prophecies that do tend to happen when inflation expectations move up and down. But again, with inflation moving back down to that target, with growth where it is, that's kind of my argument, that the economy is, I mean, not doing just fine, but the Fed doesn't need to come out and start jumbo cutting, because you do risk inflation reigniting to the upside. And again, number 3, that because financial conditions are easy, in part because markets expect the Fed to deliver a string of cuts, igniting risk assets could make it harder to finish the inflation fight. So, the most important part about this year, especially to me, is the fact that the market started pricing in that 50 basis points this week, and the market continued to trade up into those all-time highs. So, just looking at this statement here from NikkeiLeaks, obviously is going to have me lean towards the Fed doing a 50 basis point cut. Now, does it really matter whether they do 25 or 50 right now? Well, it doesn't, but it also does. It only matters in the sense, in really this statement right here, if you cut 50 here and you think the Fed will need to cut again after that, you are unlikely to regret such a cut, even if the economy chugs along between now and your next meeting. But if you cut 25 and things worsen a lot in the coming weeks, meaning like inflation starting to move to the downside aggressively and unemployment starts to spike again, and you also see growth starting to move to the downside, that's what people will be worried about in this event here. Also, inflation expectations. So, to kind of wrap this all up in a bow, I would really be on the same page as these market expectations for a 50 basis point rate cut tomorrow. 67% probability. Do I think that's the right thing to do right now? Not necessarily, but again, I'm not a Fed president or on the Federal Open Market Committee, so I don't get to make those types of decisions. But that's what we're looking at going into tomorrow, everybody. Now, I do also want to give you guys a brief rundown again of what we're looking at with USD JPY, the dollar, and bonds. So USD JPY has reversed its course, moving to the upside here. That is a good sign. Again, we do want this to move back up so we don't risk any further repatriation, because again, JP Morgan said it was 75% unwound. I don't think there's any real reason to believe them that a multi-trillion dollar quote-unquote free money, highly levered trade was unwound with nobody having any significant systemic issues, really meaning financial institutions failing, like small hedge funds or medium-sized hedge funds, and any banks taking significant losses. So, looking at the dollar over here to just wrap this up here, then we're going to look at bonds. Dollar still kind of in that 50-50 zone, where if the dollar breaks lower here, that's probably not going to be great for the market. If the dollar starts to trade higher, again, more demand for dollars could mean that there's more demand for U.S. assets as well. And then let's take one last look at the bond market here to give you guys this understanding before we wrap it up. Ooh, U.S. 10-year. I don't want the actual bonds. Let's see. So again, yields started to bounce back up a little bit today, nothing too crazy. And again, with the broad market, we did see a little bit of movement. And tomorrow, I really would not expect anything to happen before the interest rate decision comes out. And this is kind of what I want to leave you guys with here. There are going to be a lot of people tomorrow that are going to blow their accounts because they decide that they want to try and do too much with too little on the FOMC days. Do not let that be you. The market is still going to be here the next couple of days, and it is your job to make sure that your account is as well. You guys have seen time and time again the amount of opportunities that we are able to take advantage of in the market every single day. These types of weeks are all about capital preservation so that you have more capital to deploy at those A-plus setups that are inevitably going to form. So team, that is going to wrap it up for this one. I will see you guys on the Powell live stream tomorrow. Other than that, have a great rest of your evening. Peace.